Welcome back in, everybody. So Fedex absolutely collapsed on Friday. They reported earnings, pretty bleak outlook. Definitely looks like we're having the consumer slowing down right before the holiday season. And the other thing we're starting to see is that this super cycle that Apple was all pumped up about is starting to look pretty disappointing, as there's already being discounts for the new iPhone. So even with all this AI hype, we still need a consumer that's willing to purchase and spend on these products that a lot of companies are spending a tremendous amount of money to push out there. I think this holiday season is going to be pretty disappointing, and I definitely think things are going to look a little bit ugly. But in this video, I specifically want to focus in on Fedex. Now, I've done an analysis on UPS, and I have an ideal stock price between about $110 to about $113. So in this video, we're going to run an analysis on Fedex, get a price target. Along with that, I want to just touch on the technicals of the market, because there's some things that I think you're going to be interested to see. If you like this type of fundamental analysis, make sure you like and subscribe, and welcome into Compounding Capital. The first chart I want to pull up here is going to be the dollar. US dollar has absolutely weakened, and what are we starting to see here is that the US dollar could be breaking out here pretty soon, as it's starting to find a bottom. And what does that mean for the overall stock market? That means that's going to put pressure on the overall stock market. It's going to be harder for the stock market to go up if the dollar strengthens. As you guys can see here, still at a point of resistance, so we don't have confirmation of a breakout on the dollar yet, so nothing to be worried about, but definitely something we want to keep an eye on, as this will definitely be downward pressure on US stocks. Now, in this video, I'm actually going to give you an actual stock price where I think the S&P 500 is going to tap out. A lot of things are pointing to this. Now, the first signal was absolutely the dollar, but let's go over to the S&P 500 chart, and I'm going to show you why I think the S&P 500 is going to tap out at 5,810, maybe 5,825. Somewhere in there is where I think we actually form a top in this market. As you all can see, we are hitting new highs in this market. Configuration is still definitely positive. This is not a market I would try to short or get cute on. I definitely think you could stay long up until the first week or so of October. I have earmarked October 15th, but beginning of October, we're probably going to see the market start rolling over here. I have a high risk period coming in right here, and this would be October 15th. We're starting to see the market really run out of steam here. It's getting harder and harder to hit new all-time highs. The thesis has always been about getting inflation under control, a strong labor market, and AI. But where we've really stopped looking at has been valuations. Valuations are in the upper decile. We're trading at 28 times earnings, and historically this is extremely rich. As we start hitting the high risk period, I do think this trend line is going to end up being a point of resistance. We broke above it, but then we came back below. I definitely think we're going to chop sideways, but we're still going to make higher highs, with this being the point of resistance. This has been since the October lows. It's been a consistent resistance point in this market. We broke above it a few different times, but we have a hard time maintaining above it. As I stated, I think we'll break out as high as maybe 5,825. But as we start reaching into October, there's a few things on the technicals that are telling us that things are going to start rolling over. And then when we line that up with valuations and the dollar, it seems that this might be where the market starts hitting a top. So a couple things we can kind of look at to start seeing the signals before it gets too crazy. If the dollar starts to strengthen, we're probably getting closer to a market top. We have the technicals that are starting to kind of get tapped out here. They're running out of steam. They're running out of fuel. There's only so much money that's going to keep driving this market up. It's definitely running out of steam. It's getting harder and harder to hit new highs. It's getting harder and harder to figure out what's the next catalyst that's going to push this market even higher. Because when we look at valuations, it's pretty expensive. So I'm just going to leave it there for you guys. But I do think we're starting to see some signals here that the market's getting ready to roll over, and it's getting ready to roll over in a higher risk period. But as of right now, everything is still very bullish. It's definitely bullish configuration. I wouldn't say you need to sell anything at this point in time, but I definitely keep an eye on the dollar. If this dollar starts to strengthen, that's going to be our first signal that we might want to start looking at taking some profits at all-time highs. Now, the first thing I actually like to do sometimes is do the technical analysis to see where support can be before I do my fundamental analysis, because when they line up together, that usually gives me pretty good confidence that I'm picking a good entry point on the stock. So when we look at a 5-year chart on Fedex, and I take it from the recent 5-year low, and I just run a trend line up right here, I can see here that we're basically looking between $190 to $200 of a support zone here that I think is in play. Similar to the iPhone sales here, what are we seeing? Fedex flags major shift in consumer behavior that's hurting profits. We're starting to see that consumers are really tapping out here. Now, we've heard about it, but now we're starting to see it come through on earnings, and this is where we're going to start seeing it come through on stock price. So once again, when we revert back to what's taking place, we see a bottoming process in the dollar. We're seeing a consumer tapping out. We're seeing a market hitting all-time highs, but the technicals are rolling over. And now we're getting signals from things like Apple and FedEx that maybe the consumer is tapping out. But for us, we have to look at it from an open lens here. There's some things that are pointing to some frothiness in this market for sure. Now, before we get into their quarterly report, I do want to show you guys that revenue is growing. It's not an upward direction here, but it went from 83.9 billion to 87.5 billion. Now we can see a couple spikes here, and that's where we get those spikes in the stock price, right? Earnings is always going to follow stock price. So if we scroll down here, we can see they were doing $19.52 of earnings, now doing $16.37 of earnings. They were doing less revenue, but they were more efficient, now doing more revenue, less efficient. So we can see US priority took a small hit, US deferred took a small hit, US ground took a small hit, and total US domestic package revenue overall took a small hit. So where this gets really disappointing is when we look at it from an EPS standpoint, they're doing $3.24 versus last year doing $4.28. So as I stated before, that price action is always going to follow those earnings, and this is why we've seen a pretty significant sell-off in the stock. You know, if we just annualize that $3.24 out and we look at where the stock's trading, let's do some quick paper math here. Currently, the stock's trading at $255. We divide that by the $12.80 of earnings. And we're basically looking at a company that's trading around 18, 19 times earnings. Not anything outlandish, but for a company that is pretty much struggling, paying a premium on that, looking at a forward PE of 20, is pretty rich when earnings are coming down, revenues are coming down, efficiencies are coming down. But where my biggest disparity is with the company is when we look at operating income here. Take a look at the Federal Express segment, really taking a massive hit here. This was doing 1.3 billion, now doing 953 billion of operating income. So margins are a big problem here. When we look at sentiment around the stock, take a look at this, 200 as a low, 350 as a high. When we did our technical analysis, we're pretty much in line with that 200 price target. One thing people love about FedEx and UPS is that nice dividend yield. So they've been paying that dividend for 21 years and growing that dividend for the last 3 years. And obviously valuation looks to be reasonable, but we just did some paper math and it could be actually closer to its peers. But now the question is, what kind of multiple do we want to put on the stock? Currently, they're trading around 8.5 times enterprise value to EBITDA. Industry standard is sitting closer to 11 to 12 times. So I'm going to put an 11 multiple of enterprise value to EBITDA. We calculate that out, and you guys can see here, 192 is an ideal entry point. From a free cash flow standpoint, we can be looking closer to $200, basically lining exactly up with the technicals. Pretty wild to see that actually. And I'm really not doing anything crazy here. I'm basically saying they're going to have about 1 to 2% growth rates and possibly get back into that figure of doing about $90 billion of top line revenue and just keeping up with inflation at that point in time. So I'm not using anything outrageous here. Now, I put a double-digit rate of return in there when we factor in that 2% dividend. You should be, when you're reinvesting that 2% dividend, you should have a double-digit rate of return with that price target that I put out there. So basically, my price target is going to line up in about 190 to about 195 is an ideal entry point for FedEx. So hopefully you guys enjoyed that. And as always, I appreciate your time. Thank you so much for spending it with me. We will see you guys in the next one.